Dustin, very good to see you. I have an important question. Are annuities a good investment? The third quarter of 2023 saw record growth in annuity sales. In fact, according to LIMRA, which tracks the numbers, total annuity sales reached $89.4 billion. That's an 11% jump over the same quarter last year. So we know there are many different types of annuities. They generally serve one of two functions: as an investment or as a quasi-pension plan offering income for life and retirement.
That's a great point, Aaron, that there are multiple types of annuities with different purposes. It's a really important point because most of the time when we hear conversations about annuities, they're generally either framed as good or bad.
Right.
And that's not the case. An annuity is just a tool. Let me talk about tools for a moment. So
Do it.
outside of the office, I do some blacksmithing as a hobby. So this is a tool. This is a blacksmithing hammer. This is a peen hammer. This is a hammer that's meant to move metal very quickly and efficiently in two directions. Okay. This is a rounding hammer. It looks like one hammer. It's actually two. Got a round face to move metal very quickly and efficiently in all directions, 360 degrees. Got a flat face for planishing or smoothing metal. Okay. All of these tools, each of these tools have a distinct use and purpose. And any of these tools can be a fantastic tool or a lousy tool, depending upon what you need and what you're trying to do with that tool. Okay. Mm-hmm. Annuities are no different. They're not good. They're not bad. They're just a tool. And they're either going to be a fantastic tool or a lousy tool, depending upon how you try to use them in your financial plan.
Okay. I love the example there, Dustin. So let's walk through the different kinds of annuities that there are. And first, we have fixed annuities. What are they?
Sure. So fixed rate annuities, very simple and straightforward. They're going to pay a fixed interest rate for a fixed period of time. And, they can generally be a good alternative to CDs. For some time, we didn't really pay much attention to fixed rate annuities. They weren't all that attractive. That's really changed since the Fed has been hiking interest rates. The rates on those fixed rate annuities are now pretty attractive and impressive in many cases. Generally, you can lock in a higher rate than you might be able to in the bank and savings or CDs, and you can generally lock in that fixed rate annuity, the rate on that product, for a longer period of time than you might an annuity. And finally, this might come to a surprise to a lot of folks. Contrary to what you may have heard, for most of those fixed rate annuities, as long as you're holding that product to maturity, oftentimes there are no fees or charges.
Mm-hmm. All right, now let's hop on to indexed annuities.
Okay, so indexed annuities, just like a fixed rate annuity, your principal is protected. Okay, oftentimes outside of any kind of riders you might attach to that contract, there are no fees or no charges if you hold it to maturity. And just like fixed rate annuities, the terms on indexed annuities are now much more competitive than they were a short time ago. Unlike a fixed rate annuity, an indexed annuity does not pay a stated rate. Instead, it gives you the ability to participate in the movement of an index like the S&P 500. So in years where the S&P 500, for example, is up, an indexed annuity would pay you interest or allow you to participate in some of those gains up to a cap, but not participate in any of the losses in any year where, for example, the S&P 500 were down.
Mm-hmm. So would you recommend that risk-averse investors allocate a portion of their bond portfolio to annuities?
Yeah, a lot of times it depends upon the investor, but many times we do try to blend that approach. We might look at taking a portion of the bonds in a client's investment portfolio and replacing some of those with a fixed or an indexed annuity. And one of the reasons we might do that is cost. Again, if we can use an annuity that comes with no fees or charges and replace some of the bonds in the portfolio, well, we can avoid having to pay fees and expenses sometimes on the bond side of the portfolio. So bring down the overall cost, make it more cost effective for our clients. Mm-hmm. The second reason that we'll encourage that blended approach many times is guaranteed lifetime income. Okay, if you take a look at any investment product, cash, stocks, bonds, if you have one of those accounts and you take a set income from that account year after year and you spend down all of the principal and all the return in that account, Aaron, what happens to your income at that point? Once you draw that account to zero? I'm sorry?
Yeah, no, exactly what you said.
It stops, right? Your income stops once the account value is zero. Did you know that if you've got an annuity and you're taking a contractual income payment from that annuity each year, even if you spend all of the principal and all the interest in that account down to zero, a $0 balance, the insurance company continues to send you an income year after year.
Mm-hmm.
Okay. That's something that can't be replicated in any investment account. So that's valuable to many clients.
Right. That's why a lot of people see it like a pension. All right. Last, Dustin, I do want to ask you about variable annuities as we take a look at this visual, which shows us, the annuities by scale of risk.
Sure. So variable annuities, they may be one of the reasons why annuities in general sometimes get a bad rap. So unlike many fixed annuities or indexed annuities that oftentimes come with no fees or charges if held to maturity, a lot of variable annuities come with some significant fees, expenses, and charges. Now, that doesn't mean that no investor should ever consider the use of a variable annuity. There may be some cases, and I know there have been cases in the past where, some variable annuities offered some very competitive income guarantees or death benefit guarantees that might make it worth, paying those expenses and charges for some investors. But if you're not looking in particular for those income guarantees or those death benefit guarantees, you might just consider purchasing an investment account, something like built with, low cost ETFs or stocks, could oftentimes be an alternative that'd be a lot more cost effective way to invest.
Interesting. I'm really glad we had time to talk this through because, again, I think this is a question a lot of people struggle with answering for themselves. But as you said, many different purposes they can serve. So if somebody wants to talk to you about annuities, Dustin, what's the best way to reach you?
They can shoot me a text at 830-476-2505 or reach out on the website to book a free chat at longlivemymoney.com.
All right, Dustin, thank you so much for your help today. I really appreciate it.
Thanks, Aaron.